Good afternoon, ladies and gentlemen, and welcome to Foord's Meet the Team event for direct investors, and a very warm welcome to those who are joining online as well today. I'm going to apologize in advance if we use any unavoidable technical jargon. We're going to try to make it as understandable as possible, and we'll try to simplify things as much as possible. Thank you for your ongoing support of Foord. We are a safety-first investment house, and that means we perceive our first duty to investors to be the safeguarding of investment capital long before we even think about safely compounding meaningful inflation-beating returns over the long term. Now, this means that sometimes we forego investment returns that might be on the table because we perceive that the risks of permanent capital loss are too high. That said, we are also high-conviction, long-term investors, sometimes taking investment positions that will generate outsized returns only many years hence, requiring patience from investors today. I guess the last couple of years are good examples. In 2021, our caution was premature when global markets rallied strongly on massive government stimulus and the post-pandemic reopenings. But we were vindicated last year when global share and bond markets fell precipitously. This year, markets have seesawed between optimism and worry. We've seen some expensive areas of the market, such as US tech shares, become ever more expensive, and some cheap areas of the market, such as Chinese equities, become ever cheaper. But more on that shortly. For those of you who don't know me, my name is Paul Kluwer. I'm Managing Director at Foord. I'm joined today by investment professional Linda Eedes and by Foord's Head of Private Client Investing, Mike Townshend. Now, Linda joined the investment team last year, and she should already be a familiar face and, I guess, voice to Foord investors. She hosts a series of podcasts and webinars with the investment team. And if you're not already subscribed, please do subscribe to our YouTube channel, as well as to our podcast channels on Spotify and Apple Music. Now, after me, Linda's going to look at what's happening in global markets, the macro investing environment, and how we see the risks. And then Mike is going to look at how the portfolios are positioned to deal with those risks in the coming year and beyond. Now, I hope that today's presentation gives you the courage and comfort to stay invested, even if there are some material risks on the investment horizon. Firstly, they might not come to pass. And secondly, even if they do, the portfolios are well positioned to deal with them. They have ample liquidity to be able to buy quality investments at cheaper prices, setting investors up for some really outsized returns in the next investment cycle. So last year, we spoke about how global central banks were rapidly raising interest rates to combat soaring inflation. In the developed world, at least, peak inflation is now well past us, but interest rates are still at multi-decade highs. And that's largely because global central bankers are uncertain as to whether they have fully tamed the inflation beast. Now, the effects of high interest rates are lagged, and they're only now being felt in the real economy. They act as a brake on economic activity. And the question on everyone's minds is whether that brake will be gentle to slow the economy, or whether it will act aggressively to cause the economy to lurch to a halt and even into contraction. Now, as we'll show you today, almost every period of rapidly rising interest rates is followed by an economic recession. And we've not had an interest rate-induced global recession for 15 years, not since the 2008 global financial crisis, and you'll remember just how big that one was. But that doesn't mean that we're due for something as big as that. But it also doesn't mean that we are going to escape one, simply because we haven't had one for 15 years. So this is going to be a theme of today's presentation. Are we headed for a recession? When might it come? What will the effects be on financial markets? And what if we are wrong in our estimation? I'm going to turn now to the asset class returns to have a look at the opportunity set for fund managers, see what's been available to us in the portfolios. And I'm going to use the same format that I used last year. So this year, 10-month period, calendar year 2022 and calendar year 2021 as discrete comparative periods. They each tell a very specific story. In 2021, we had those big up years. 2022 was a big down year. And as we'll see now, this year is mixed to negative. I'd like to just first draw your attention to the 2022 year. As I said, it's that big down year when global bond markets and global share markets each fell about 18% in US dollars. And in fact, when we met last year at this time, the position was worse because share markets recovered somewhat in the last weeks of last year. But just keep in mind those big negative drawdowns last year as we look through the rest of this year and in our forward fund returns. Turning to this year, we can see that global share markets, to the end of October at least, were up 8% in US dollars, but very narrowly so. They were pulled up by a handful of mostly mega cap, mostly US tech stocks. And we're going to have a look and see what that looks like when we exclude the best performing shares. Global bond markets were down 3% for the year to the end of October, but just look at that asset class over this nearly 3-year period. If you compound those numbers, it's down 27%. You certainly didn't want to be invested in global bonds over this time, and we were not. That said, we have more recently started to add low-risk global bonds to our global portfolios, and we'll see those later on in the presentation. Turning to China, to the end of October, down 13% in US dollars. Look at that market over those nearly 3-year period. It's all but capitulated. It's down 49%, so it's effectively halved. Now, why is that? Well, it's fallen for a number of reasons. Firstly, on sentiment. China is out of favor geopolitically right now. It's not attracting foreign investment, and that's keeping a lid on its market prices. Then there's a number of own goals that the country has scored over this period. You might remember that regulatory crackdown on the very successful tech and education sectors. The market didn't like the consolidation of power under President Xi. And more recently, I guess, some very real worries about the over-indebtedness of the property development sector. It's a big sector in China. And I guess generalized worries that the Chinese economy hasn't fully recovered yet from those very harsh lockdowns that they sustained. But as Linda will show you, that market is still growing faster than any other big market. So as we will see, the sheer magnitude of those declines have weighed on the performance of the Foord global funds this year because they have some of their investments in that market. But in this, we think it's largely a timing issue and that the market will recover when the Chinese economy recovers and sentiment returns. So we think it's timing and that we'll get that back in the next 12 to 18 months plus, but will require some patience now. South African shares to the end of October down 2% in rand, in US dollars down by 10%. Now, why has the market fallen? Well, the commodities or the resources sector of the JSE was a good performer over the last number of years. It was running, but we've seen the rotation. That sector has now fallen. It's down 17% for the year to the end of October, and that's pulled the market down with it. South African bonds, very high yields that are available on South African bonds help the South African bond market to a small but positive return for the second year running. Now, we have some bonds in our portfolios, but we certainly weren't all in. And I guess that was a good call given the fact that their prices have come lower and we had a very nominal return from the bond market over this period. South African listed property, negative on the headwinds facing the South African economy. Gold bullion, up on safe haven appeal. Oil, a little bit up, notwithstanding those worries about global growth that we're going to talk about. Normally, that puts a lid on oil prices. But here, I guess we can thank OPEC for continued price rises there. And then the rand, weaker again against the US dollar. And the dollar, certainly to the end of October, stronger against most currencies. Here we show the euro. And just to point out, over that nearly 3-year period, that rand depreciation is 20% against the US dollar. So quite meaningful rand depreciation. Okay, so I said I'd unpack the global market returns. Global commentators like to give quirky names to groups of shares. In the 1950s, there was the Nifty 50. More recently, we had those FANG stocks. In fact, I think a competitor of ours has a FANG unit trust. You might want to invest in that, but you also might not want to at these valuations. But they've now morphed into the Magnificent Seven. And I guess maybe we can expect a name change from that unit trust soon. But who are they? They are Google parent Alphabet. They are Facebook parent Meta Platforms, Apple, Microsoft, EV maker, Tesla, online retail giant, Amazon, and chip maker NVIDIA. They're all US companies. 5 of them are each valued at more than $1 trillion in terms of their market capitalizations. Together, these 7 companies are worth $11.3 trillion, and they now account for nearly a third of the US S&P 500 index. And that's an index of the 500 most valuable companies listed on US stock exchanges. And just for further context, these 7 companies are worth nearly 10 times the entirety of the JSE put together. So they've all had meteoric price rises, as you can see from the green line. That's this year's price rises. Some of them on the back of the AI frenzy that gripped global markets this year. They're all valued at above or substantially higher than US markets in terms of valuation metrics. Here we're showing PE multiples, price earnings multiples. And just to explain what that is, let's look at NVIDIA, 111 times when we pulled this chart. What does that mean? It means that if you bought that company today, it'll take you 111 years of its current earnings to recoup the purchase price. 111 years. So just think about that. It is priced for an enormous amount of growth, and it's effectively priced for perfection. Now, we've been long-term shareholders in Google and in Microsoft and the Foord Global Equity Fund at about 5% of that portfolio for many years now, but we haven't held the other shares, and nor are we about to overpay for them now at these valuations. Okay, on this chart, I'm showing you for this year how these companies have 7-handedly pulled up US indices. As an equal-weighted group, the Magnificent 7 are up 78% this year. You can see the US S&P, that index of 500 biggest companies, is up 10% this year when we pulled this chart. But if you exclude the Magnificent 7, the 493 other companies as a market value-weighted grouping are only up 1.7%. And in fact, if you equal weight them, so instead of the bigger companies counting more in the index, they each have an equal weight, then those 500 companies on average are down 4% this year. And my point is that it seems to me at least that once you take some big US tech out, the bear market that was with us last year is probably still with us. So I'm going to, as I move into the Foord unit trust returns, just consider the opportunity set. You can see that it's been mixed to negative this year. There have been some opportunities in South African and global cash, in US tech, as we've seen, some South African shares, and in precious metals. And of course, all foreign assets are worth proportionately more when translated into rands, given the rand's 9% depreciation against the dollar this year. So I'm going to start with the performance of the Foord global funds. These are in US dollars. The underperformance of these funds this year has weighed on the South African multi-asset funds that invest into them, so it just gives you some context for when we get there. I'd like to just turn your attention to the 2022 year. Look at the Foord International Fund. Global share and bond markets were down 18% each. It really was a bloodbath last year. The Foord International Fund was up 2% in US dollars. So when you got your statement, you didn't see that it moved much, but the opportunity set was so much worse. I can only describe that as a piece of stunning outperformance. Look at the peer group. That's a grouping of similarly managed funds with similar mandates. It was down 13% last year. So outperformance like that is not always sustainable. And so when we look at this year and the 10 months to the end of October, the minus 8% of the Foord International Fund, some of that is just a retracement. It's a bit of a giving back of the outperformance last year when it was measured to a discrete point to 31 December. Bit of normalization of that. Some of that is the cost of the hedges that we have in that portfolio. Mike is going to speak to you about what they will do. But really, there's a cost to protecting the portfolio against very worst case outcomes. That's a theme of Linda's talk. And I guess some of that minus 8% is due to the China exposure. This fund has 10% of its fund in China, and that's weighed on returns this year. But as I said, that we expect to be a timing issue and that it will recover. The Foord Global Equity Fund has about 25% of its portfolio in China, and that accounts for most of its underperformance this year. but just consider how dirt cheap those stocks are compared to the very lofty valuations of some of the shares that we don't own in the portfolio, and just think about how those will each normalize. Both of these portfolios are well placed for a recovery in China, for interest rates to stay higher for longer, and also for a sell-off in US tech or sell-off in shares more generally. Just last bit of context, if I go back to the end of 2021, so 1 year, 10 months, this is the bear market that I've been talking about. You can see global bond markets are still 21% below. That's that blue-gray line at the bottom. Global share markets, even though they've been pulled up by the Magnificent Seven, still 12% below where they were at the end of 2021. Foord International Trust has outperformed these, including the peer group, over this time. It's not where we wished it to be at this time. We'd hoped for a better outcome, but it's still doing its job. So the cycle isn't over yet and will require some further patience on this fund. Right, the Foord South African funds, these are in rands. So the previous slides were in US dollars. These are in rands. Just first draw your attention to last year, the 2022 outcome. We haven't quite spoken about it. The Foord multi-asset funds, they're the funds that can invest in all asset classes and even abroad, the three at the top. Just look at their returns last year. Resilient outcome in a very negative opportunity set. Low positive returns. This year we see mid-single digit returns from those funds, but for different reasons. So it's also resilience. These are also good outcomes, actually, given the opportunity set. The Foord balanced and conservative funds are also very well rated on a relative basis compared to their peer group funds, right at the top. Foord Flexible Fund, in which many of you invested, has lagged a bit because it has more of its investment in the Foord Global Funds, which we've spoken about, but also stands to benefit more from a rebound in those underlying fundamentals. I recognize that for effectively 2 years now, these kinds of returns are not what investors want when they look on their statements, but they still serve to compound savings during very difficult operating environments, and as we wait for periods of better returns to come. And they will come, but probably not until we've had a proper economic reset, which will be a theme for the rest of the talk. The Foord Equity Fund hasn't been a star performer for 5+ years. It had a low weight to the cyclical resources sector, which was running for a long while. It was a headwind. It's now become a tailwind as we've seen a rotation out of that sector, beat its benchmarks last year, and has shown some really good outperformance of the benchmark this year. It's got a ways to go to catch up some of that underperformance, but we've got a dynamic and talented team on that account, and I'm personally optimistic that we will get that back. And then it will be remiss of me not to deal with the new fixed income funds that we launched last year. They've been in operation for just over a year. It's the Foord Flex Income Fund and the Foord Bond Fund. We can see that since inception, they've both performed very much in line with their respective mandates. They're cautiously positioned. It's not a time to be adding a lot of risk in these portfolios. Just to note, the Foord Flex Income Fund had a return of 8.3% per annum since its inception. That's after costs. And because its return is largely linked to the interest rate cycle, we can't guarantee that returns on that fund will always be north of 8%. But it's not a bank account and it's not a money market fund, but it's a very safe place to be parking cash for up to 2 years. So if you have any short-term savings needs, please consider this fund first. So that's it from me from the backward-looking part of the presentation. Linda's going to look at the health of the South African and global economies now. She's going to look at prospects for a US recession and what the consequences of that might be.
Thank you, and hi everyone. I'm Linda, as Paul says. Thank you for joining us today. I'm going to start my section with a little story from my own personal family history. So this gentleman on the left-hand side is my grandfather, James Arthur Pledger, my father's father. He's here with his brother Alec. They were both members of the Royal Air Force, and more specifically, they were aircraft mechanics. Now, my grandfather was 19 years old when World War II broke out. And in October of 1941, he boarded this vessel, which was called the HMS Ark Royal. It was an aircraft carrier, and its mission was to take Hawker Hurricanes to the coast of Malta, where they would be reassembled, fly from the aircraft barrier to the airbase. But on the way back, disaster struck. The aircraft carrier was hit by a German torpedo, which tore a hole in its hull of 30 meters by 10 meters. My grandfather remembers that there was a massive crash. The ship swung around and immediately started to list starboard. And they knew then that they'd actually been hit by a torpedo. Now you can imagine the panic of the people on board. Now, to give you an idea of the size of this vessel, it was more than 240 meters long, and there were more than 1,500 men on board. When it started to list more than 30 degrees, the captain gave the order to throw anything that would float overboard. So any wood, any debris, just in case the crew ended up in the sea. And eventually he gave the order to abandon ship. They all calmly scrambled down ropes into rescue boats below. And 1,749 men survived. They watched from a distance as the ship eventually inverted, broke in two, and slipped under the ocean, where she still sits today, 1,000 meters below sea level. Now, the reason why I tell this story is that it speaks to the risk management process of the Royal Navy. The fact that they were able to get all of those men off that vessel safely before it sank speaks to the fact that they decided well in advance what their process would be in order to manage the worst case scenario. And I think it's really a good analogy for how we manage portfolios, because we've got to think of all the risks on the horizon, some of which I'm going to detail for you today, and make sure that we have a process that protects against the worst case scenario, that then allows us to take advantage of the opportunities that come beyond that. And there's good reason for that, which is that mathematically speaking, if you have a loss, and obviously the worst case scenario is a permanent capital loss. Now, when does that happen? That happens when you think something is worth a lot more than it is, you pay that high price, you turn out to be wrong. That loss is not coming back. That's a permanent capital loss. That's your worst case scenario. But even in the case of unrealized losses, where market prices move down dramatically, you have to more than make up that loss just to get back to square one. So if you think about what we're trying to do for you over time, which is to actually generate inflation-beating returns over time, we really want to protect the portfolios against losses. First and foremost, permanent capital losses, but in actual fact, this is why we talk so much about the importance of having portfolios that hold their ground when markets are down. We're in good company, by the way. Probably the world's most famous investor, Warren Buffett, has two rules. Rule number one, never lose money. Rule number two, never forget rule number one. Now, the great thing about investing is that time is your best friend. Time is on your side. But here's the catch. Only if you stay invested. So we can manage the risks for you, but you need to allow us the benefit of time to capitalize on the opportunities that come beyond that. And here I'm showing a range of returns for the Foord Flexible Fund of Fund, which many of you are invested in. It's been around for more than 15 years. And there we have Dave Foord and his book, which you can get if you don't have a copy outside on the tables. And it says time in the markets. And of course, that comes from that famous saying, which is that it's not about timing the market, it's about time in the markets. And you can see here that what we've done is we've shown the range of return over 1 year. The worst case scenario over 1 year, you would have been down 12%. And the best case scenario would have been up 38.8%. But as you lengthen that time horizon, two things happen. That range of returns narrows, so you have less of those wide swings one way or the other. And also you've got this upward sloping curve as well. So what this means is that actually, if you look at the 10-year time period on the far right, your worst case scenario over 15 years, so we use a 1-month rolling number for this, so 15 years times 12, your worst case scenario would have been 8%. So that's still actually 3% above inflation. But your best case scenario over any 10-year period would have been 14.5%, which is 8 or 9% above inflation. And that is, of course, a phenomenal return. I think anybody would be happy with that. But it just gives you some context about how important it is to stay the course, especially when you have volatility over shorter time horizons. So let's talk about the horizon that we're looking at the moment. And I'm going to talk a little bit about some of the risks that we are assessing. Mike's going to talk about the opportunities that we're taking advantage of. So do bear with us. We've had one of the most aggressive interest rate hiking cycles in the last 40 years in the US. And of course, we always start with the US because it does set the benchmark for the rest of the world. And in the red dotted line over there, you can see this is the current interest rate cycle. So this just measures the time on the axis below, horizontally, and how far interest rates went up. And you can see two things. First of all, this interest rate cycle has been shorter than any of these others. It's also been sharper. We've actually ended up 5.5% where we started. So it's been the sharpest, shortest, most aggressive interest rate hiking cycle in the last 40 years. And that is still working its way through the system, and that takes time. Now here we're showing that interest rate over time. So this is, again, the Federal Reserve's interest rate, the central bank for the United States, and there's that last little blip that you can see on the end of that curve. You can see that stark rise, that rapid rise there. And what we've also showed, each of those triangles is the peak of various other interest rate cycles, so the highest point. And the shaded parts of the graph are the recessionary period. So that's when the economy contracted after interest rates, of course, had been rapidly hiked. And one thing that you'll notice is that often, most times, those economic contractions came after interest rates had actually started to fall. So at the moment, we're sitting 17 months from the first interest rate hike. Now, the average from the first hike to a recession is around 21.4 months. And there is some encouraging data coming out of the US, but it is far too early to say that we are out of the woods yet in terms of a slowdown in the United States. Financial conditions have tightened considerably. Now, what does that actually mean? Here we have an index which Goldman Sachs puts together, and really what that just measures is the access that individuals and companies have to loans, to credit. How easy is it for you to actually go and get a loan? And you can see that there's a steep upward sloping part of the curve there with regards to how financial conditions have tightened in the US. So banks are becoming much more careful about who they lend to. And you can imagine the knock-on effect that that eventually has on an economy. Second of all, 30-year mortgage rates have rapidly risen over the last few years. Now, not that long ago, you could actually lock in a 30-year mortgage at under 3%. They're now hovering around the 8% mark. But here's the interesting thing about US mortgages. Most people, more than 95% of mortgage holders, actually have fixed mortgages. So what that means is that until you actually sell your house and buy another one, you can keep your low mortgage rate. So you can imagine what the knock-on effect of that has been. It's been a frozen housing market because no one's willing to actually give up these really good low mortgage rates that they locked in a little while back. But you can imagine that if you have an economic contraction, people start to lose their jobs, and you start to see foreclosures and people can't afford their mortgages, there will have to be forced selling, and that could be a significant knock-on effect to the US housing market and, of course, many other parts of the economy. So you are starting to see those high interest rates trickling through into various parts of the economy. Now, much of the US economic resilience has owed itself to fiscal spending. Now, what does that mean? That's the government, of course, spending. And what we've measured here is basically the US budget balance. How much are they spending versus how much they make? And obviously, most of what they make is in the form of taxes. And you can see that's in negative territory. And this is actually measured versus GDP. So it's measured relative to the size of the economy. And you can see that the US government is really in a bit of a tight spot with regards to how much they're spending compared to how much they're actually bringing in. And so how do they do that? Like anybody who spends more than they makes, they've obviously got to issue debt. They've got to borrow money in order to do that. And we're thinking very carefully about the risks that that introduces to other parts of the market. The fact that the US government may need to issue more debt than there is demand for, and the implications that has on various asset classes. The US labor market has been incredibly resilient. I mean, here we have the US unemployment rate. It's ticked up a little bit, you can see, but it's still sitting at 3.9%. I mean, we could only dream of an unemployment rate like that. We had recent numbers coming out yesterday, above 31% for South Africa, and yet the US is sitting at 3.9%. And there's actually more than 1.5 job openings for every one unemployed person in the United States. Now, there isn't always a nice match between the two, but it just gives you a sense of the fact that there's actually more demand for labor than there is supply. And if it remains the case, then that could have significant implications for inflation being higher, because of course wage price inflation is a core component of inflation, particularly core inflation. So that's the inflation inherent in the actual system. If unemployment obviously continues to tick up, you can imagine the knock-on effect that that might have on consumer spending, on the US housing markets, and so on and so forth. So this is something we're watching very closely as well. But there are other regions of the world that are actually still faring much better than I think the media would have us believe. Looking at China retail sales versus the US, you can see that historically the red line, which represents China, has actually been generally much higher than the US. And of course, that's thanks to the huge economic boom that they had. And you can see that China retail sales fell off a cliff, and that was obviously with regards to COVID lockdowns. They were very, very severe. People were not allowed to move around. They came down very hard on that. And of course, retail sales took a dive. On the other hand, you can see what US retail sales did. Now, why was that the case? Because, of course, the government was putting money in people's pockets, and people were sitting at home with nothing to do but extra money to spend, some of them with more savings than they've actually had in a very, very long time. But you can see the trajectory, and we obviously need to think about where are these cycles headed. And the US is heading down, remembering that, of course, the fiscal spending has been ahead of an economic contraction. So one of the ways that obviously governments try to help economies when you're going through a tough time economically is that they spend. But given where they are with regards to their spending levels and debt levels at this point already, it leaves them with very little firepower. On the other hand, China actually is sitting in a budget surplus. So they still have some firepower to actually continue to stimulate their economy. We like to fish where the fish are. So what does that mean? There's two parts to investing. The first is what you invest in. And looking at various economic regions, we of course like to look at areas which are growing, which offer opportunity. And then of course we've got to decide which businesses we buy. And we want to buy businesses with growing earning streams into the future. And if you actually look at China, even despite the fact that obviously it's been a bit of a stop-start in terms of the economic growth in that region relative to expectations, they're still expected to grow by more than 5% for 2023. In comparison to the US, which yes, of course, it has fared a bit better than expectations, but it's still only growing at, it's expected to be 1.6% for this year. And you can see Japan is similar, and Germany is actually expected to contract. So again, we need to fish where the fish are. And Mike's going to speak to some of the opportunities. But if you look at the overall index levels, and Paul mentioned the concept of price to earnings. So this is a collective of all the share prices of all the companies in each of these indexes, and then measuring that versus the underlying earnings of all of those companies. You can see that the Asian indices are actually at very attractive levels. In comparison, you can see the NASDAQ sitting close to 30. You can see the S&P, obviously in very lofty territory. So fish where the fish are. The one thing is what you buy, the other thing is the price you pay. Now, the price you pay, you can buy the best businesses in the world, but if you pay too high a price, you're not going to end up with a very good investment return. So those two things are critical, and Mike's going to give you a bit more detail on the types of companies that we're investing in there. Turning to South Africa, unfortunately, as most of you will know if you read the headlines, the South African government also has a debt problem. So you can see here, this is the debt levels from 2006 through to what is expected 2025. The dark blue or the gray bars are the projections. But nonetheless, we've added a line for inflation because when I first looked at this chart, I said, yeah, but inflation, it would have been going up. These are nominal numbers. Well, there's where it would be if it was just inflation adjusted. So our government has continued to increase its debt levels. And it's getting worse. One thing we look at for all governments is to look at their levels of debt relative to the economic output of their country. So that's the gross domestic product, the GDP. And these numbers are very small, but if you actually look 10 years ago, the debt to GDP levels were around 30%. They're now north of 70% and expected to get worse. So this is a dire situation. Obviously, with interest rates having risen so dramatically, and this is the case for the US government as well, of course, with interest rates also being much higher, this means far higher interest expenses on that debt for the South African government, rather. And I'm sad to tell you that actually almost 20 Rand of every 100 Rand that you pay in taxes actually just goes on paying the interest on government debt. Not paying back the debt, paying the interest on that debt. So you can imagine that that also crowds out spending in other really important areas of the economy that we desperately need spending, such as infrastructure, healthcare, education. And what do we have to show for all of this spending? Remember, I showed you how the US economy had been quite resilient. Consumers had extra savings. That fiscal spending had actually, translated into quite a robust economy. Unfortunately, it hasn't been the case. We've got very little to show for that in South Africa. Our economic growth over the last 10 years on average has been around 1%. Now, bear in mind that the population is actually growing by more than that. So on a per capita basis, we're actually getting poorer. So from an economic growth perspective, it's not looking good. One of the reasons why economic growth has been so poor is that investment levels in South Africa have been very low. Now, gross fixed capital formation is just a fancy term which includes all the equipment, machinery, construction, building, anything that could actually increase the productive capacity of your economy. And you can see that it's really fallen off a cliff. And one of the reasons for that is that, unfortunately, it's been underinvestment on government's part. But the silver lining here is that the private sector has actually taken up some of the slack. And you can see in the blue bars, that's private sector spending on construction. And we have some interesting ideas in our portfolio that we're taking advantage of, which actually benefit from this. But government spending in various areas, including construction, has actually been going down. So that's not looking good, but it does mean that we have lots of problems to solve. And of course, where there are problems to solve, there are businesses taking the opportunity to solve those problems. And that's where we look for the opportunities. We've got an election next year. In fact, I read somewhere that 78 countries have got elections next year. The ones I know of, obviously, are the US, India as well. But yes, 78 countries actually have elections next year. So it might be a little bit of a bumpy ride. Politicians tend to do crazy things ahead of elections. We do some political analysis in-house. It's important to make the point that this is not a forecast. This is basically using by-election data to say, if we had the elections today, this is what we think the results would be. And you can see that we do expect the ANC to drop slightly below the majority, so at 46.5%. The DA, unfortunately, has been losing some ground. The EFF has been gaining some ground. And you can see where the other parties are. What does this mean? Well, coalitions, unfortunately, while they actually could be a solution, they have tended to bring a lot of instability. So that could be a bad thing for investment because, of course, any uncertainty does tend to lead to decision makers not actually investing, rather sort of wait and see approach as to how things pan out. Unfortunately, the rest of the world is saying South Africa's become a more risky place to invest. We actually want a higher return. And so the yields that, of course, our US government is having to pay for debt is higher than it has been historically. But that can also be a good thing for investors because we can also lend money to the South African government and earn higher yields. It also means that if we invest at very low valuations, we may get very good returns from some of the businesses that we invested in. We are encouraged by a DA-IFP coalition in KwaZulu-Natal. Perhaps that will be the blueprint for how coalitions work. But the important thing is that we have to be very, very selective about what exposure we have within South Africa, particularly those domestically focused businesses. So there are still clouds on the horizon. Higher rates are taking their toll. It does take time for that to work their way through the system. And there are high levels of government debt already. So that's not a good thing sort of going into potentially a difficult economic period. Inflation risk has started to moderate. There were some good numbers coming out of the US, but there are still risks of recession. The lag between the first interest rate hike and the recession is still well within the norm in the US, and that would also obviously have knock-on effects for everywhere else. South African growth has slowed. Our infrastructure challenges do hinder growth, so those are problems that we do need to solve. And South African government does unfortunately have a debt problem, and that debt is not actually going into the right places. The spending is not going into the places we like to see. So we face heightened uncertainty going to 2024, which is why we talk so much about risks. And I know sometimes many of our investors say, but you're too conservative, you're too cautious. We have to manage those risks in order to be able to take advantage of the opportunities that come beyond. Holding our ground in difficult markets is an absolutely critical part of growing your capital over time. So we need to proactively manage those risks while seizing opportunities. And Mike's going to talk about what opportunities we do see, because there are opportunities out there. But lastly, I want to just go back to that gentleman I introduced you to at the start of the presentation, James Arthur Pledger. Had he not been one of the 1,749 men that had actually managed to be rescued safely from the HMS Ark Royal before it sank, he wouldn't have ended up being stationed in India next, getting off in South Africa with an ailment, ending up in hospital, and meeting a pretty young nurse called Marie Jeppe. He wouldn't have had 3 sons. He wouldn't have spent the rest of his life in South Africa. He wouldn't have 7 grandchildren, and he wouldn't have 9 great-grandchildren. His whole goal in his later life was to get to 100. And do you guys know, are there any British citizens here? Do you know what happens when you get to 100? You get your card from the Queen. I suppose it would be the King now. And here he is on his 100th birthday, having got his card from Queen Elizabeth II. Was actually one of the last cards that she signed. And the message that I want to leave you with is to finish first. You have to first finish. Thank you very much.
Hello, ladies and gentlemen. It's always a privilege to be up here in front of you. I just was talking to somebody a bit earlier. He traveled all the way from McGregor. We have another client who's been with us for 40 years. So it's very special to be here in front of you. Okay, so I'm going to talk about how we're positioning the funds at the moment. The first thing I'm going to do is just show you what we spoke about last year and whether we got that right or not. And you can see on the right-hand side that we were worried about inflation, interest rates were going up, and so we had to be quite conservatively positioned. That safety first, which is what Linda mentioned in her part of the presentation. We were starting to take selective bond exposure. Interest rates had risen and were making them more attractive. And then because of all the uncertainties, we had quite a bit of gold in the portfolios. We were very concerned about the rising interest rates and what impact that was going to have on growth. There was fear of a recession. We were not sure how deep that was going to be. So we had to position the funds cautiously and buy good quality companies that would be able to do well in that sort of environment. And we spoke about the Chinese exposure that we had at that time. So you can see from the ticks that we have that largely we got it right. What we perhaps did underestimate was the impact that the rising interest rates would have on the valuations of companies. So even though a lot of our companies did well, their share prices got hit quite hard despite their earnings continuing to grow. And then the exposure to the Asian markets, that didn't play out, but we'll get onto that in a bit more detail a bit later. So Linda's covered the sort of the macro view, and I'm going to talk to that now. I'm not going to go through all of these points, but interest rates and inflation rates are peaking, close to peaking right now. The inflation hasn't hit us, as she mentioned, but it is likely to come. But the good news is that we don't think it is going to be as bad as what we initially felt. Another risk that has come out over the past year has been geopolitical risk. Last year we were talking about the Ukraine war. Now we have the Israeli-Palestinian conflict, which is causing a lot of problems. And the big fear is that it spills over into that greater Middle East area and perhaps draws in some of the world superpowers. So that's something that is also weighing on markets to a certain extent. So I'm going to leave this now and jump in directly to the Foord International Trust and how we've positioned that fund. So this is a very important fund in the Foord stable, because a lot the Foord Conservative Fund, the Foord Flexible Fund, the Foord Balanced Fund, and others invest directly into this fund. So, and as Paul mentioned earlier, it's gone through a tough year after a very good year last year. So we just need to unpack this fund in a bit more detail. I'm going to leave the equity portion at 63% till the end, because I've got some more detail on that. But the first thing you can see here is the 20% exposure that we have to bonds. Now remember, almost 18 months ago, we had no bond exposure whatsoever in the portfolio. As interest rates have risen, bonds have become more appealing, and we've now taken a position mainly in the shorter dated bonds, which are less risky and where you can get slightly higher inflation-beating returns at the moment. We've still got a cash position of 6%. Last year this time, it was over 25% that we had in cash in this portfolio. And then we've got that commodity holding of 7%, which is all in gold. And I've got a slide later just showing you how well that has performed, which is as you'd expect in an environment of heightened geopolitical risk. And then we've got that very small exposure in the property sector, mainly high-grade property office space in Hong Kong. So let's just come now to that equity component of 63% of the portfolio, which you may think is quite high given all the risks that we're seeing in the market right now. So I'm just going to unpack for you how we're trying to manage that risk. What happens if our view goes wrong? And that's a question that we ask ourselves on a daily basis at Foord. So what we do have is some hedges or futures which have essentially reduced that equity position from that 63% by 24% to 39%. Then over and above that, we have also bought some put options. And without going into the detail of what that is, it's essentially insurance that we've taken. So if our view is wrong and the S&P 500 drops below the level of 4,000, right now it's 4,500. It's had a bit of a surge this last week. If it drops 10% below where it is at the moment, that insurance policy kicks in. And you can see it reduces the equity exposure by a further 23%. So the overall equity position is actually a lot lower, or there is protection built into that equities. So we want to be there to take advantage of the companies that we feel will do well. And what we discussed last year is that equities are a very good protection against inflation over the longer term. So we want to have that equity exposure, but we also have some protection in place, as I've just explained. And to spend a bit more time on the equity portion of the fund, what I'm now going to do is talk about a couple of the themes that we have in this portfolio. The first one should not surprise you at all, which is healthcare, which tends to be quite a resilient portion of any economy over time. And there are lots of, similar to me, grey-haired people in this in this audience, and you might be interested to know that actually the fastest growing cohort in the global population is the people in the age 65 plus category. So not only is that portion of the population is growing, but as we get older, we tend to spend more and more on healthcare. My mother-in-law's had a knee operation, she's had a hip operation all over the last year, and she's here healthily watching us. But the fact is that she spent a lot of money to get here. And a lot of people do that as they age. So, but not only is healthcare expenditure growing, it's also quite stable, as you can see in that orange line there, compared to GDP growth, which is that black line, which you can see is a lot more volatile. So it's a resilient part of the economy, and we've tried to choose companies, which you can see on the right-hand side, which grow steadily, and they tend to be very cash-generative businesses and pay good dividend yields, and so we've got a healthy allocation to that in the portfolio. The next one is China, which Linda and Paul also spoke about a bit earlier. And in China, the valuations are very cheap. And what this slide shows you is the extent to which the Chinese market has underperformed global markets. So the Chinese market, as shown in that sort of bluish color, is at the bottom, and the S&P 500, the biggest stock market in the world, the US stock market, in orange. And you can see there's been severe underperformance by the Chinese shares over the last 2 years in particular. But we're finding good quality companies there that are growing in the mid-20s, compared to the average on the S&P 500, which is only in the mid-single digits, sort of 5 to 7, 8%. So not only are these Chinese companies growing significant, or the ones that we have in our portfolio, not only are they growing significantly faster than the average developed market company, but they're at significantly lower valuations, as Linda showed you early on. We're at half the PE multiples of the rest of the world. So we prepare to be patient for those companies to come through and deliver for us. The next theme is materials. Now, this is traditionally a cyclical sector, and you might wonder why we've got this in the portfolio. But the thing that I must point out here is that we're exposed to a couple of different areas within the materials space. So we have industrial commodities, we've got precious metals companies that do well for example, when the gold price moves up as it has. We've got agricultural commodities, and then despite the EV and green revolution that's taking place at the moment, a lot of the energy companies have sold off heavily and are very cheap, continuing to deliver a lot of cash and paying very good dividends. So we've tried to identify the companies within this material space that we feel are less cyclical, can grow in this environment, even though some commodity prices might be under a bit of pressure, and deliver for the portfolio. Okay, so we're confident that the equities that we have in the fund will do well even in a tough environment, and we just have to wait for them to deliver. So the next fund that I'm going to move on to is the Flexible Fund. And you can see, first of all, the similarity with the Foord International Trust, that pie chart that I showed you earlier. Whereas here we have 65% in equities, Foord International Trust was 63%. This fund has 61% invested offshore, and you can see we have a preference for global equities over domestic equities in this fund. And just to mention, because this fund invests in the Foord International Trust, we also do have that protection, that equity protection built into the Flexible Fund as well. We have 15% in bonds. Again, we didn't have anywhere near that a year ago, but then what you've got to look at together with that is the 16% in cash. So together that's 30%, and last year nearly all of that would have been in cash. Now the benefit of having that cash and bonds is that they are delivering you a real return with very low risk. So remember, the mandate of this fund is to deliver inflation plus 5% over the long term. So with a 10-year bond in South Africa at the moment, you can get 11.5%. So at relatively low risk, and you can get a decent portion of this portfolio that you're almost guaranteed of beating that inflation plus a few percent target that we have. And then we also have the gold exposure in this fund. Okay, so let's move on to South Africa. Linda spoke about some of the difficulties we have here, and I'm not going to go through all of these companies, but you know the extent to which the state-owned enterprises in South Africa are really failing us and making it difficult for companies to grow. We were in Durban on Monday. I counted 40 to 50 vessels out in the bay. I've never seen so many there before. And you saw on the front page of today's headline, Woolworths was saying that they're actually fearful they might have stockouts on their clothing division because they're not able to get the product into the country. And that just reflects the ports of one example of the state-owned enterprises that are constraining the ability of companies to grow. Now, you may remember we've had the Rugby World Cup last year, and our first game was against the Irish. That's South Africa in white over there. You can see the despondency on the players, all the hype building up into that game, and we lost it. But what a lot of people forgot is that this was the number one team in the world, and Ireland, and they were tipped to go all the way through to the final. But we know that the team overcame a lot of the adversity and the naysayers, and this is one of my favorite photographs from last month. Just the joy in that team is just palpable when they actually delivered for all of us back here in South Africa. And I think that why I've put this photograph up is that I think it reflects some of the views that we have in South Africa. Yes, there's a lot of adversity, there are a lot of problems, but for fund managers who can see the opportunity set within that space, you can still deliver decent returns. So let's go into that a little bit more as to where we see the opportunities. And the first one is valuations. This is the PE ratio of the South African market, and you can see not only is it very low, it's a 10 times PE, what we're trading on at the moment, which is half of what most developed world markets are, but it's only the second time in this 20-year history that it has been as low as what it is at the moment. So that just tells you that the companies are very cheap. Now, if you buy into those equities, that cheapness means that the downside risk should be reduced, and then the upside returns, if the economy starts to grow a little bit, should be commensurately higher as well. So the valuations are on our side. Second part of the market that is offering opportunities is the bond market, as we've discussed. And the orange number is inflation, what we're seeing in the US on the left-hand side and South Africa on the right-hand side. The black bar is what returns you can get on cash at the moment. And then that final grey bar is the 10-year bonds. And these are the returns we anticipate over the next 10 years from each of these asset classes. And the clear standout is that 10-year bond here in South Africa, where you can get 11.5%, 6.1% above the 5.4% of inflation that we expect over the next year. So a decent inflation-beating return. Then gold. We've mentioned gold a couple of times. This chart just shows you how well gold in rand terms has done over the last year, and particularly over the last 2 years, where so many other asset classes have been knocked. And this is as you'd expect when geopolitical risk rises, how gold, its safe haven appeal really works its wonders, as it has done in our portfolios. It's not only the shares that you hold in the portfolios, but it's also what you don't hold that adds value. And you want to avoid those losers. Safety first. And what I've got here is the platinum sector in that black color versus the JSE. The platinum sector not only is a lot more volatile, as you can see over this 2-year period, but it has significantly underperformed the JSE. It's down by over 50% year to date. We have no platinum shares in the portfolios at the moment, so that's a loss that we've missed out on, and that has certainly added value. And it just also reflects in that commodity sector how quickly changing prices can impact the profitability of an industry. Just a year ago, these platinum companies were reporting super profits, and right now they're in retrenchment mode. It's a dramatic change. So let's look at the equity fund and how we are positioned there, and does that reflect what we've been talking about so far. Because I was talking about resources in the last slide, let's just start with that towards the right-hand side. The black bar shows you what the weight of the resources sector is on the JSE, and then that orange bar shows you what our exposure is. So we've got 9% versus the 30% in the JSE, significantly underweight. No platinum shares, as I mentioned, and we've got the better quality diversified miners like Anglo American and BHP, who we feel their earnings are a lot less volatile than other parts of the resources sector. The next one, I'm just moving to the left, is the overseas companies. Now, over the decades, the good quality South African companies have managed to grow offshore and then grown into the international markets as well. And we've got big exposure in this area to Naspers Process, which reported this last week. Very good results. The share price has jumped nicely, and that's a big weight in our portfolios. The other company is Aspen, that has also grown overseas. Companies like Bidcorp, and then Anheuser-Busch, the old South African breweries. So that's that chunk that we overweight on the overseas companies. And not only are they able to grow internationally in dollar terms, Now that then means that if you translate those dollar earnings into rands, you also got a hedge against, a weakening rand, which we feel the rand is likely to continue weakening over time. We have found some good quality South African incorporated companies, but compared to the benchmark, we're slightly underweight in that area. And then if we go all the way to the right-hand side, the left-hand side, you can see that we've got a big weight still in cash. And so that is also just waiting opportunities as they arise. If we have a sell-off, or if we feel that valuations are going to take a knock, we can then take advantage of good quality companies that get sold off and put them into the portfolio. So that cash is also earning a positive real return at the moment. Okay, so this just shows you some of the companies that we have. I'm not going to go through them. We're finding good businesses in the banking space, in the healthcare space, and then South African industrials. I will just mention Wilson Bailey. Linda had that slide about how the government is not spending on infrastructure in the country. But this is where the private sector comes to the fore, and we know that everybody's spending on renewables at the moment. There's still some road works and construction work is taking place, and Wilson Bailey Homes is one of the best quality construction companies still listed on the JSE, because so many of them have actually delisted as a result of the lack of spend in that sector. And so that's a few percent in our portfolio, and we're confident they're going to deliver decent earnings as well. So this is the last slide, and it's just a summary of what we hold in the portfolios and what gives us confidence that we are going to be able to deliver positive real returns in our funds. Bonds are offering reasonable value. South African equity valuations are appealing. We being patient with regards to these Chinese shares, and so often patience does come to the fore in the markets, and we feel that there are good reasons why they should bounce back. Gold continues to be important. Cash we've increased, and we've still got a decent amount of cash that's positioned for those opportunities. And then we just need to start thinking about that post-recessionary recovery. So yes, we're not in that recession yet. Recessions they tend not to last as long as the boom periods. So we may have a recession over the next few months, but you also have to have the opportunity set or the positioning to take advantage of the bounce that comes thereafter. And often markets look through that and start preparing for what can come through 6 months down the line, 12 months down the line. So we feel our funds are well prepared for that post-recessionary recovery, but at the same time, we've built in that protection in case things don't go as we expect. So thank you very much, and Paul's just going to sum up quickly.
Right. Just in terms of a brief summary and closing remarks, we warned last year that interest rates would probably have to stay higher for longer than people were expecting. And we also warned, as we've been talking about, of rising recession risks. This year, as you saw, interest rates did tick up even higher, and they are now probably at their peaks, or if not, very close to their peaks. We haven't had a recession yet, as Mike has pointed out, but the leading indicators are all still flashing red. But as we've been repeatedly saying today, the portfolios are cautiously positioned against what might be a worst-case outcome. And they have ample liquidity to be able to take advantage of opportunities that will throw up. But even if we don't have a recession, the funds have a good amount of growth assets and good optionality and should do well under any scenario. There's a lot of Foord staff here today. We're all wearing these orange name tags. We've got our Chief Investment Officer with us today. We've got portfolio managers on the equity funds here. We've got our fixed income portfolio managers as well. Please approach any of us with your questions. Thank you.